So you're here because something inside of you says, there's got to be more than working 40 years to retire broke. Maybe you've got no trust funds, no inheritance, no head start, and you're wondering, is it really possible to retire with $1 million if I'm starting from zero in my 30s? The truth is yes. It's not just possible, it's surprisingly doable if you approach it differently than most people. This isn't a video about chasing meme coins, flipping NFTs, or finding overnight success. This is about building something real like actual financial freedom from absolutely nothing. Now, if that sounds like a bold claim, I get it. Most people assume that becoming a millionaire requires big income, luck, or some breakout business idea. But the reality is that thousands of people retire as millionaires not because they did something extraordinary, but because they did something consistently. This time isn't about how can I get rich quick. It's about how to engineer your lifestyle, money habits, and mindset in your 30s to create wealth by design. Let's start with the emotional part. If you're in your 30s, you may be juggling rent, debt, work stress, and maybe even a family. You scroll past videos telling you that you should have invested at 18, bought Tesla in 2018, started coding in high school, or skipped Starbucks. And now you're wondering if you're too late. Let me tell you this, you're not. Your 30s are actually the prime decade to build wealth because now is when you have enough income flexibility to save, but still enough time for compounding to do its thing. You don't need to be perfect. You just need to build a system that works around your reality for your schedule, your income, and your energy. You need a strategy for building wealth that respects the fact you don't want to be glued to stock tickers or spreadsheets. That's why this plan is built around automation, simplicity, and compounding. Let's break down exactly what it takes to retire with $1 million, even if you're starting from absolutely zero. First, let's define the actual math. If you're 30 and you want to retire with $1 million by 60, you've got 30 years. Investing $500 a month with a 9% average return, which is the historic long-term average of a diversified stock market index, would get you to about $1 million by age 60. Not magic, not hacking the system, just math. If you can swing $700 or $1,000 a month, you'll get there even faster. Can't afford $500 a month right now? Keep watching because we'll walk through how to slowly work your way there. We'll also cover how to significantly shorten the timeline. Think retirement before 60 if you master 5 keys. Income growth, low expenses, smart investing, automation, and long-term mindset. You don't need to max all 5, but every one you improve compounds the rest. Let's talk about income first, because no amount of budgeting replaces the power of increasing your income. Most people in their 30s under-earn, not overspend. Your first wealth-building mission in your 30s should be to boost income, not cut out every coffee. Start by figuring out your primary skill that people will pay more for. That could be getting certified, shifting industries, freelancing, or building a scalable side income. If you increase your income from $45,000 to $65,000, and save the gap, you've literally added $20,000 of investing capital per year without clipping coupons. Use lifestyle creep to your advantage. Anytime you get a raise or bonus, funnel it directly toward your freedom fund, not a new SUV. You can still upgrade things later. But right now, income acceleration is your fastest hack. Let's walk through a realistic plan. Let's say you start at $500 per month invested. Over the course of a year, you find ways to increase your income: remote work, freelance, new job, and bump that to $750 per month. You automate that amount to go directly into an ETF portfolio. Do this for 10 years, reinvesting dividends, and assuming even modest market returns, you're well into 6-figure territory by age 40. Keep the habit going, and by 50, you're printing serious income passively. Next, let's simplify investing. You don't need to pick stocks, follow Wall Street, or even know what the Fed said last week. You don't need to be smart. You need to be systematic. The quickest path from $0 to $1 million is using broad market ETFs like SCHD, VTI, or total market index funds. These low-fee funds expose you to thousands of companies, pay dividends, and historically deliver solid long-term growth. You auto-buy those every month, reinvest dividends, and slowly increase the amount over time. Think of investing like stacking bricks. At first, your wall feels useless, it's not tall enough to do anything. But brick by brick, it gets stronger. Dividends become bigger. Each month of contributions becomes the foundation of passive income. By year 5, you start realizing you've built something. 10 years in, your friends are still guessing what to invest in, and you've got a silent money machine on autopilot. Let's address fear. But what if there's a crash? There will be. In fact, there will be multiple crashes. Markets correct all the time. But guess what? Millionaires are often born in bear markets, not bull runs. Your 30s should be where you embrace volatility, not run from it. When markets are down, your consistent contributions buy more shares for less. That accelerates your wealth curve. When compounding hits its stride, downturns are no longer scary, they're sales. Here's an emotional shift worth internalizing. The size of your wealth doesn't come from one great trade, it comes from hundreds of boring, consistent ones. Every time you invest, you're casting a vote for the future you. You won't win every month, but it's winning long-term where millionaires are made. Your job isn't to time peaks. It's to never stop building. Okay, so in part 2, we'll dive into automating your path to $1 million. How to structure income buckets, tax advantages, and more ways to hit your goal faster even if you've got debt or a late start. Let's get tactical now. You've got the mindset. You've accepted that your 30s are the launch window. So what's next? Structuring your plan so it runs smoothly without mental burnout. First step, automation. Automated investing is the cheat code most people never use. Not because it's hard, but because it's boring. And yet that's what makes it powerful. Here's what automation looks like. Every time you get paid, a portion of that income is automatically transferred to your brokerage account. From there, it's automatically invested into your ETFs of choice. No decision fatigue. No emotion. No missing a contribution because the news looks scary. The market doesn't need your opinion. It needs your consistency. Let's break it down even further. You set up recurring transfers to your brokerage, say you get paid bi-weekly. You schedule $250 every 2 weeks. That's $500 per month. Next, you configure recurring investments into your set of ETFs, maybe a 60/30/10 split. SCHD for dividend growth, VTI for total market growth, V&Q for real estate exposure. These buy orders happen on autopilot. You don't touch it. You don't time it. You just leave the system running and refill it with your income. Now let's say, a few months in, your job gives you a raise. Take half the raise and increase your auto invest by $50 per month. That's the game. You're not trying to overhaul your life, you're upgrading the machine in small steps. Instead of lifestyle creep, you create wealth creep. The system naturally scales with your income. That's how you jump from $500 per month to $750 to $1,000 over a few years without it feeling painful. And it's totally okay if you start small. The millionaire math works at every level, it just gets better the longer you do it. Let's run some numbers. If you invest $500 per month from age 30 to 60 at an 8% average return, you'll end with approximately $745,000. That's already a game-changing number. But let's say you increase your contributions slowly, up to $1,000 per month. Now we're talking about $1.4 to $1.7 million. And this doesn't include surprise windfalls, side hustles, or one-time bonuses you redirect toward investing. In your 30s, you also need a plan for financial layers. Think of your wealth like a 3-tier cake. Layer 1 is your core investing habit, the monthly ETF contributions on autopilot. Layer 2 is your emergency fund or cash buffer, so you're not forced to sell investments in a downer. Layer 3 is your high-opportunity cash money you set aside for dips, buying during crashes, or catching one-time deals. This layering prevents emotional reactions. You've got a consistent base, a safety net, and playroom, and that makes the entire plan more sustainable. Another overlooked key is tax advantage. If you have access to a workplace 401k, especially with a match, use it. That is free money. Try to max it out over time, but don't wait until you can do the full $22,500 in one go. Even putting in 10% of your paycheck gets the ball rolling. Then make your Roth IRA the next step, $6,500 per year, tax-free growth, tax-free withdrawals. Use it for ETF investing, dividend income, or index strategies. The taxable brokerage account can come last. Yes, you'll pay some taxes on dividends and capital gains, but this is also the most flexible bucket you can pull from it before retirement age, access funds in an emergency, or reallocate quickly if your strategy matures. Together, These three accounts form your income factory. One builds for 59.5. The next is your midterm option, and the third is your early access dividend vault. But the real magic is that each account, no matter how it's structured, runs on automation. Here's the shift. You're building a lifestyle that doesn't require perfect decisions. You're building a portfolio that pays you every month, even while you sleep, travel, or go through tough seasons. It's no longer save, retire. It's invest consistently, simplify, expand freedom. And that creates optionality. What's optionality? It's the ability to say no to things that don't serve you. It's the mental space to turn down extra hours, to take a sabbatical, to scale back when life hits hard, or scale up something new. That's the real retirement. It's not about leaving work forever. It's about never being trapped by it. You can afford to walk away when needed because your ETFs keep showing up every single month. Now let's zoom out and address the what if I fail worry. There will be off months. There might be unexpected expenses. You might break your streak. That's okay. Compounding doesn't punish you for missing a month. It rewards you for getting back on track. Unlike crash diets, this plan accepts imperfection. It's about total volume over time, not streaks. If you've already skipped some years in your 20s, don't beat yourself up. You're not late. You're not behind. You're waking up now, and that's your personal day one. You get 30 years to build financial independence. Whether you have 29 left, 20, or 10, the answer is the same. Start small today. And don't compare your blueprint to someone else's highlight reel. Their rental portfolio, trading story, or TikTok side hustle is irrelevant to your consistent ETF contributions. You are building something stable. You don't need fireworks. You need momentum. In part 3, we'll go deeper into how to stay motivated, avoid burnout, optimize your ETF picks, and why boring portfolios are more powerful than you think. Let's talk about something that doesn't get nearly enough attention when it comes to long-term wealth: emotional fatigue. Automation is powerful, but let's be honest. There will be weeks you question it. You'll stare at your portfolio and wonder if it's growing fast enough. You'll see people flipping houses or swinging options and think, am I doing something wrong? You're not. You're doing the thing that actually lasts. Boring wealth? That's what you want. Anyone can get lucky, but it takes consistency to build something permanent. The person with $300,000 in slow-growing assets by 40 has more real peace than someone constantly chasing 30% returns they can't keep. What you're building is a machine. It doesn't need hype. It doesn't need volatility. Just time. Think about this. Every share you buy, whether it's of SCHD, VTI, VNQ, or any diversified fund, it's not a number on a screen. It's ownership in real businesses. It's infrastructure. Apartments being rented. Products being sold, real profits that become real dividends. And those dividends? They don't disappear at random. Good funds keep paying even through downturns. That's the quiet magic of disciplined investing. Now let's get a bit tactical again. How do you choose ETFs that align with this strategy? First, remember the rule. Avoid funds you don't understand. If you can't explain in 2 sentences what a fund holds and why it pays you, you probably shouldn't invest in it. Let's break down 3 core ETF types you can lean on. 1. Dividend growth ETFs like SCHD. These are your stability engines. They include profitable, dividend-paying U.S. companies with a history of increasing their payouts. These funds grow slowly, but the cash flow increases over time. In short, predictable. 2. Broad market ETFs like VTI. These are your exposure plays. Low cost, total market coverage including small, mid, and large-cap U.S. companies. They don't pay huge dividends, but they build your total value and ride up with the market over time. 3. High-yield income ETFs like JEPI. These generate frequent, strong cash flow. JEPI uses covered calls to boost income. It's a little fancy under the hood, but it's designed for consistent, monthly checks. Doesn't explode in value, but it shows up for you. Once you understand how these complement each other, you can mix and match your asset allocation. A common split for someone in their 30s might be 50% SCHD, 30% VTI, and 20% JEPI. If you're more aggressive, you might take down SCHD a little and bump up VTI. If you're cash flow focused, tilt heavier toward JEPI. There's no magic mix, but there is a magic habit: sticking with it. That's where so many people struggle. They overbuild the strategy, get obsessed with reallocating, and constantly optimize themselves out of progress. Meanwhile, the investor who simply kept buying SCHD every month on repeat is sitting on $600 per month in passive income 8 years later. Keep it simple. Use what's easy to track, and never underestimate the compounding power of doing nothing extraordinary, just staying aligned. Let's shift gears for a second and talk about motivation. Because strategy gets you started, but belief keeps you going. And in your 30s, life gets busy. It's easy to push finance to the side when there's work, family, health, or just the overwhelming sense that I'll start later. But here's the mindset flip. Starting small doesn't cost you anything. Starting late does. A $100 per month start, with 10% bumps every year and reinvested dividends, can still grow into 6 figures in 15 to 20 years. But wait 5 years to start, and now you're playing catch-up forever. Time is your biggest asset right now, not money. Don't trade it away hoping for something easier later. If you're struggling to stay excited about your progress, gamify it. Track your monthly dividend income. Measure how many bills you've covered. Maybe your phone plan is now paid for by SCHD dividends. Celebrate that win. These small victories make the bigger numbers digestible. You want this to feel real. Because once you feel ownership over your income machine, you won't want to stop feeding it. That's how momentum is built. Quick recap of what we've covered so far. You don't need to be rich or start early. You need to be consistent and give your money time to work. Automation is your best friend. Set up recurring transfers and reinvest dividends. Choosing ETFs with complementary goals, growth, yield, stability, simplifies your plan. Emotional distractions are normal, but your plan is stronger than your doubts. Now let's address a financial force multiplier, increasing your contribution rate slowly. Don't rush. Just aim to nudge your investment up by 10% each year. If you start at $500 per month, raise it to $550 the next, then to $600, and so on. Not only do you get better outcomes, but you also condition your lifestyle around rewarded discipline. No guilt, no stress, just your investment habit growing alongside your income. This pattern alone, slight increases over time, is why regular people build incredible portfolios. Not because they made huge bets, but because they did small things longer than anyone expected. In Part 4, we'll look at sample timelines, how to avoid common mistakes, and what you can realistically expect by age 40, 50, and 60 if you stick to this plan. Let's walk through a few milestones. You're 30 years old and starting today with $500 per month. By 35, you've been consistent, bumped your contributions to maybe $650 per month, and stayed invested in a simple ETF allocation. Nothing fancy. Maybe some months were tight, but you kept showing up. Your portfolio is now somewhere between $45,000 and $52,000 with dividends contributing around $1, $200, $1, $800 per year. By age 40, if you've gradually scaled up to $1,000 per month, your balance could realistically sit in the $125,000 to $150,000 range. Dividend income? Somewhere between $4,000 to $6,000 per year. That's about $400, $500/month, money going into your account while you live your life. Now, by 50, assuming average market performance and consistent reinvestment, it's not far-fetched to have a portfolio climbing toward $500,000. Passive income approaching $15,000 to $20,000 per year. That's huge. And this isn't magic. This is what boring, disciplined investing looks like when you let time make up for speed. And by the time you hit 60, $1 million, and then some. A dividend-paying growth engine you don't have to babysit. And even more importantly, time. You'll have more of it. Because the job decisions, life decisions, and stress levels most people grapple with in their 50s won't hit as hard when your portfolio is quietly handling part of your lifestyle for you. Now here's the funny thing. Most people give up in the first year. Why? Because it doesn't feel like it's working. Maybe they put in a few hundred, they see the market dip, or they only get $7 in dividends and think, what's the point? But $7 is the signal. It's proof the system is online. Future you will have 100x that number because you didn't quit during the slow part. You want the system to grow faster? Feed it more. Want the income sooner? Stack more shares. Want stability? Don't sell. Just stay consistent. Here's a hidden benefit to this strategy that people don't talk about. When you invest monthly and stop checking prices daily, your stress disappears. Price volatility becomes background noise. Income becomes the signal. Your dashboard says paid $47.88 from VTI, or JEPI paid $93.11. While other people panic over red days, you get paid to own. You get paid to be still. That's not just investing, that's peace of mind. And then there's the lifestyle creep problem where your income rises, and so do your expenses. But with this plan, each raise becomes an opportunity to build wealth one adjustment at a time. Instead of spending every raise, you shift 20%, 30%, maybe even half into your investing machine. It's barely noticeable month to month, and yet by the end of the year, you're contributing hundreds more without making your lifestyle feel restricted. That change alone puts you years ahead of 90% of the population. Remember, this isn't about optimizing every trade. It's about optimizing your habits. That's why I keep saying you won't get there because you're a financial genius. You'll get there because you set up a system that worked when you weren't thinking about it. Your brain was offline, but your money was working. That's when things click. Now, what happens if you reach $1 million but don't want to stop? Well, you don't have to. This plan doesn't come with an expiration date. You can go beyond, even hit $2 million. An income at that level, you're into financial independence territory. You've moved from freedom from stress to freedom of choice. Retire? Keep working? Volunteer full-time? Start a business with no pressure to profit? You've got options. Let's zoom back out for a second. Why do people not make it to $1 million even though it's available to practically anyone with steady income, time, and commitment? Because they get distracted. They change plans halfway through. They try to time the market. They listen to fear. They follow trends. Or they simply forget to start. But you? If you're still watching this video, you're not that person. You're someone who's learning how to break the cycle of guesswork and design a real answer to the question no one asked you in school. How do you retire without getting lucky? And now we're close to wrapping this up. So let me do what every great investing plan should. Show you what to do next. In part 5, we'll walk through your very first steps, from setting up your account, choosing your ETF split, automating your money, and tracking results even if you only have $50 to begin. Because getting started isn't about money. It's about movement. So let's talk next steps. Because watching this video is great, thinking through this plan is great, but action is what makes the whole thing real. You don't need to memorize 50 investing terms or read 20 books to begin. All you need is a few minutes, a stable phone connection, and one simple decision. Let's make it easy. Step 1. Open a brokerage account. If you don't know where to start, platforms like Fidelity, Vanguard, Schwab, or SoFi are beginner-friendly, low-cost, and easy to set up. Pick one. Go to their website. Create your account. Your future wealth can't begin until this foundation is in place. Step 2. Automate your first contribution. Don't overthink the number. Start with something you won't miss. $50? Great. $100 per month? Awesome. The goal isn't to max out. It's to prove to yourself that you took the first step. Once automation is turned on, you're ahead of most people. Step 3. Choose your ETFs. You've already met them throughout this video. For dividends and steady income, SCHD. For broad growth across the market, VTI. For exposure to real estate, VNQ. You can set a simple allocation like 50% SCHD, 30% VTI, 20% VNQ, or adjust based on your goals. The specific ratio matters less than consistently sticking to it. Step 4. Turn on dividend reinvestment. It's literally one setting in your brokerage account. This tiny toggle is what unlocks compounding. Dividends that buy more shares create more dividends. It turns your entire portfolio into a snowball rolling downhill, gathering momentum on its own. Step 5. Track your progress. I don't mean watching your balance every day. I mean tracking something that reflects real life. Each month, open a simple spreadsheet or app and record how much you received in dividends. That's your freedom score. That's the number that shows what your money is doing for you in the real world. And from here, you just let the system work. Add more when you can. Reinvest everything. Ignore the noise. Feed the machine. Over weeks, months, and eventually years, the strategy becomes your second income and eventually, your freedom income. Now, here's the most important thing. You might be watching this thinking, I understand the strategy, but it still feels far away. That's normal, because this isn't a lottery ticket. This is the opposite of hype. This is the slowest get-rich formula in the world and the one that actually works. You won't feel the progress after 1 month, but you'll look back after 1 year and see that your money finally listens to you. And when that moment happens, the one where you check your account and the dividends cover your phone bill or your rent or your groceries, you're going to realize this. You didn't get rich quick. You got rich right. And no one can take that from you. So here's my final challenge to you. If this clicked with you, don't just scroll to the next video. Pause. Go open your brokerage account. Buy just 1 share of a quality ETF. Maybe SCHD. Maybe VTI. Just one. Then set a $50 per month contribution. That alone is the escape hatch out of a lifetime of financial stress. Because now you know the playbook that most people never realize. Retiring with $1 million? Totally within reach. You don't need to invent anything. You just need to automate consistency and give yourself time. And look, I'm not telling you this as some guru or someone who figured it out early. I didn't. I learned these lessons through trial, errors, late starts, and small wins stacked over years. Which is why I know this works. Not because it's theory, but because I'm living it. And if I could go from zero, no inheritance, no advanced math degree, no insider edge, to having financial freedom on autopilot, then so can you. If you found value in this, hit the like button, subscribe to the channel, and drop a comment below with one thing you're committing to this month. Whether it's buying your first Dividend ETF, setting up auto transfers, or tracking your income, you taking action inspires others to do the same. Thanks again for spending this time with me. I hope this blueprint becomes your turning point. This has been how to retire with $1 million starting from zero in your 30s. Simple, proven, possible, and it all starts today.